Hey everyone, hope you're doing well. This is the Deep Dive, and I'm here with John Creekmer, our founder and senior wealth advisor. Today we are going to provide a snapshot of everything that's going on during these volatile times. And so we're going to get down to brass tacks and go through what the actual data is saying and try to help you cut through the noise. But before we do that, John, how are you doing today?
Hey, doing okay. We're in fall season, and I actually just realized that for my glass of apple cider, it actually has two times the recommended allotment of sugar in one cup. And so it's, I love apple cider. Now I feel guilty for drinking it. I don't think I'm going to stop though, but
Oh no.
fall's in the air, so we're going to have apple cider. But yeah, doing great, and just trying to navigate this world, really weird world we're in right now. It's a lot of strange things happening, a lot of things that usually zig or zagging, and we've made a lot of adjustments. Got ahead of the curve on a lot of things. Didn't stop all the pain, limited a lot of things, and we have things structured inside the plan. And we have heard so many people even talk about, hey, markets are down, my account is down. But because of the plan in place, the way income is structured, the way growth models are structured, they're in a very confident spot. That's kind of a common theme we hear from a lot of people. But Drew, man, oh man, I know you had a lot of meetings. I'm up in Chicago the last number of days, and just getting back into Denver right now. But I know you were saying a lot of people are asking, what happened? How do we get here? What is the core root cause? And I think that confusion comes from, we'll just say we have media that doesn't report facts anymore. We have talking heads that like to talk too much, that are too much in love with their own, I guess, their cult of personality, and just trying to promote things. And a lot of it's philosophical, or maybe it's partisan in what they're doing. I mean, I see it on both sides, and but it doesn't help people have confidence that what the information we're hearing is truthful. So just know you can rest assured you're not going to get partisan spin here. You're going to be getting actually facts and numbers that will help you have a better understanding of why things are moving the way they are.
Yeah. For sure, for sure. And I think you hit, John, the most important thing that, we'll get to the brass tacks, but that planning work that we do up front is the most important thing. And so if you haven't talked to your advisor recently or you have concerns about your plan, let's just stay on top of it. Feel free to reach out and schedule some time. We told all of the advisors at Creeper Wealth, let's be proactive in reaching out. So if you have a retirement coming up in the next 6 to 24 months, let's have a conversation. I know the conversations I've had so far this week with folks in that situation, they're still on track, which is the most important thing. And it really proves the quality of work that our planning team has done for all of you over the years. And so that is very encouraging. But reach out. We'd love to chat with you. John, let's kind of get into it. So biggest question that I know both of us have had is, how did we get here? What is actually going on, and why are markets so volatile right now? And so that is a very broad topic. So I'll point you in one direction. We had Chairman Powell last week come out and talk about what the Federal Reserve's game plan is for the months ahead. And essentially he tied everything to inflation, guiding their policy choices. And we know that rising interest rates historically have led to a very volatile stock market. And we have not seen markets recover in the past until interest rates slow down or stop rising altogether. And so, John, kind of what is the driving markets at this point in time?
Yeah, actually, before I answer that, I just want to apologize to everybody. I noticed I have a plaid shirt on this morning, so maybe Kinsey can put maybe a disclosure there that says that if you're prone to seizures, don't look at John's shirt because when he moves, it might cause some problems with your eyes. But apologize for that. But normally I try to wear a straight color. But anyway, it's kind of where do we get here? And so a lot of it, I want to, so again, everybody keep in mind that we're not partisan. We just simply talk about the facts and where they're at. And so we don't look one way or the other. And we're not, when we say things, we say it through the lens of what facts are. And, I know Chairman Powell and Treasury Secretary Janet Yellen both came out a number of months ago and said that last year they got inflation wrong. They used the phrase transitionary. They did not fully understand or comprehend the depth or what was moving there. What was causing inflation to move, and that it was actually more systemic, but they never really addressed why it was systemic. And so whenever we kind of look at things, at the end of the day, inflation is caused by movement. In other words, the increase in the cost of goods and services. So what we pay for our gasoline, for our food, what we're paying for our clothes and our pen, our paper products, and all of that. And so when we see the price goes up, and so we're actually sitting over the last year at kind of some historically high inflation rates, rates that we have not seen really since the late 1970s, early 1980s. And we had some drastic movements by the Federal Reserve at that time to kind of tame inflation. Why is it important to tame inflation? Inflation, it is something which it is, once it gets into the system, it's accretive. And so what that means is we have inflation one year, it doesn't go away the next year. It simply adds on it. And so if you have an inflation rate of 2%, that's the target rate, and the next year you have 2%, and so it's up 4%. Let's say the next year you have 7%, well now we're up 11. The next year we're not going to see a decrease in the cost of those goods and services across the board unless there's a change from a technology standpoint or an improvement in processing or manufacturing where they can gain greater efficiencies. And so, but the core cost is still going to be there. So once it goes, if it gets out of control, it just continues to spiral. So that's why we're going to keep it under control. The Federal Reserve, they have two mandates that they've always held to. Number one was inflation at a sustainable 2% level. And the second one is full employment, which stands somewhere around 3% unemployment. Those are the two mandates that they really kind of target. Whenever inflation jumped up the way that it did, it over 7.5% to 9.5% in the last year. Then what happened was they recognized we have an issue. So they made a mistake and didn't recognize the issue of inflation. I've told a lot of people, kind of think about it this way. If you pull up to a stoplight and you're behind a car and the light is red and it just turns green and they're not going, the people in front of you, you look up and they're on the telephone and they're engaged in a really emotional, animated conversation with someone on the phone, who knows what happened, and all of a sudden the cars are piling up and it turns yellow, it turns red, they did not go, and then all of a sudden then people behind you, they're honking their horns, they're using choice words, they're taking one of the fingers on their hand and putting it out the window, things are getting angry and heated, all of a sudden the light changes again. What does the person at the front do? They slam on the gas and get out of there, right? Because the signal changed and they never went. They never changed what they were doing and going from stop to go. The Federal Reserve last year, all of a sudden the signal started to change. Inflation started going up, Drew, and they did not change their behavior. And they said, oh, it is, you know, who knows the reason why. I have my feelings on the reason why. It was either one of three things. It was either they were really inept and incompetent in the analyzing of information. That's one thought. Another thought is that Chairman Powell was up for reappointment into his position at the end of the summer. And if he had taken too hard of a position and started raising interest rates, and that went against the thoughts or the views of the person that would reappoint him, which would be the President of the United States, he may have been concerned about his job, quite honestly, and he wanted to keep that, and so he became a political individual instead of being non-political. Or the third one is, he is just a bad person, and he wants to cause pain. I don't think that's the case, but those are the only three possibilities. They totally missed it and they were inept. They made decisions based upon something which was convenient for them, their job, or they're just not a good person. So I think at the end of the day, they made a mistake. And they admitted it. Now, the other thing is, on this other side, they're making another mistake. So what's happened is, what's caused the inflation? And this is a point of debate. You hear different things all the time. Chairman Powell, he came out in Congress last week, and he said that, you know, that the whole thing as far as with supply and demand, that has nothing to do with inflation. And I think pretty much everyone watching that was scratching their head saying, what in the world is he talking about? If we have a limited number of goods and demand for it is higher, that's like Econ 101. So when he says things, they're all of a sudden throwing that we're seeing supply chain issues or logistics is what's causing inflation. We have Russia is what is causing inflation. So we're having a lot of things out there what's causing inflation. The reality is what's caused our current inflation is what's called money supply. And so money supply at the end of the day is the driver of inflation or the driver of deflation. And so what is that? Well, that's the amount of money that's in the system. And so oftentimes we say, a lot of times, to keep it simple here, the Federal Reserve, they're printing a bunch of money. In essence, practically what that means is they're putting more dollars into the system. And so we know during COVID, we had the federal governments of the world, not just the United States, they flooded the market with cash. We gave more people a lot more money. Then all of a sudden, then we issued new policies, new provisions, new philosophies that put more cash into the system. And then recently, we did the Inflation Reduction Act, which actually put more dollars into the system through tax credits. And so what happens then is the economy is already being stimulated, and then the federal government's putting more money into the system. At the same time, the Federal Reserve, they were also doing what's called quantitative easing. Between 60 and $150 billion a month of dollars, they were putting into the system and buying bonds, and that in essence pushed interest rates lower. So we have all this money in the system, and when the money's in the system, people are spending the money. So with them increasing interest rates, that is not going to solve the underlying issue of too many dollars in the system, and that's what's causing inflation. And so at the end of the day, Drew, inflation is there because of too much money in the system. There's ways that are less painful that they can bring down inflation, but instead they're choosing to use raising of interest rates. And Drew, you might know this. Do you know how, as far as this increase and the pacing they're going, have we seen that before? Or is that kind of historical?
I think it's the fastest increase in history.
Yeah.
So that's a big reason why we're seeing so much volatility and pain in the markets. They're really using a hammer to try to fix an issue that really needs a scalpel and some logic. And so that is quite unfortunate at this point in time.
You know, I think that's something that's really interesting to look at. And so whenever we look at the U.S. stock market, there's $20 trillion of value inside the stock market.
Yeah.
And so inside the bond market, U.S. government bond market, there's $40 trillion. So just the U.S. government side is twice the size as the U.S. stock market. As far as trading volume, there's $700 billion of bonds are traded every single day, compared to $200 billion of individual stocks traded during a day.
Yeah.
So when we look at this, the size of it, the bond market is twice the size of the stock market, and the amount of volume in trading is actually 3.5 times as much. So whenever the Federal Reserve and the U.S. government get involved by buying and selling bonds at the massive quantity that they are, that's actually throwing a lot more volatility. Whenever they raise interest rates by 0.75 for 3 or 4 months in a row, then in essence, what are they raising interest rates on? U.S. government debt at the end of the day. And so that's all of a sudden going to create more volatility in the largest financial market in the world. And so that then plays into the second part is the volatility in the stock market is actually being driven by interest rates.
Yeah.
As they're raising interest rates, you see more volatility in the stock market.
So, John, we have a lot of volatility here in the U.S. markets, but there was a story that came out this past week about the Bank of England having to basically step in and completely change what they were doing, because they were also raising interest rates and selling bonds. But that led to some possibilities of pension funds in England going bust. And so I've had people say, well, is that going to happen here? And are there any international markets we should be looking at investing in? What would you say to that?
Yeah, and so, it's interesting. Whenever you look at what happened over in England, they have a new prime minister in England, and there's been, from a very conservative side, I'll say strong right side, that adheres to a lot of the philosophy of the early 1980s. And so some folks call it Reaganomics, some call it supply side, some call it trickle down. And there's, I won't give it too much depth as far as that from an economic standpoint. But then we also have, on the other side, more of a modern portfolio theory. And so what we see is two competing views, and they've really tried to execute both at the same time over there. Mm-hmm. And so they decreased taxation on corporations, which is more of a trickle-down philosophy. At the same time, they were raising interest rates. And in doing so, it confused the markets. Now, the thing of it is that all of our currencies, since no one's on the gold standard in the world, that means all currencies are pegged to each other. Right. So whenever you see the U.S. government increasing through the Federal Reserve interest rates at the pace that they're doing, then what happens is that makes all of the other currencies in the world become devalued versus the U.S., because in order to buy U.S. government debt, you have to buy that with U.S. dollars. And so there's a higher demand for U.S. dollars, which then all of a sudden causes this huge dysfunctional currency market. And so what happened then over in England was that led to really their entire financial system becoming a little bit unhinged and questioning the stability of the UK government debt is what happened.
Yeah.
So the reality is they've taken some steps since then to actually shore up the market. We saw a huge rally in the U.S. equity markets, and actually all the global markets. It would have been on Wednesday. Well, that was really tied to the Bank of England coming in and shoring up their financial system and their currency to actually provide higher level of stability. And so I think that we are seeing a little bit, I won't say contagion, that's a negative word,
Right.
but we are, from a global economy, we're all connected. That the actions of the U.S. government through the Federal Reserve is actually impacting the rest of the world. So are there other opportunities? We do see other opportunities out there. We think Europe is really in a tough spot right now. The Chinese market is kind of in a really tough spot right now. Their economy is really slowing down rapidly. But we do see some opportunities from investing in some emerging markets and frontier markets. And we really see that whenever we're going to see the kind of the peak inside of the U.S. government interest rates. As we're approaching that, that's going to end up making some more of the developing markets actually become a lot more attractive, just because of the shifting as far as in currency evaluations.
Yeah. But we would have to see that shift happen before we would enter those emerging markets, correct? Because a strong U.S. dollar does not equate to a good investment in emerging markets. Is that a fair summary?
That's a great way of summarizing that, Drew, because we don't want to shift there too soon whenever the U.S. dollar is actually still becoming more valuable.
Okay.
We want to wait until we get to the peak, which will be tied to interest rates.
Sure, sure. So, a lot of people say, hey, that's all great, and I appreciate you walking through that and providing us the background, the data there. What are we doing about that? What have we done already proactively in portfolios, and what are things that we may be opportunities we should be looking at to play this hand that we've been dealt the best we can?
Yeah, great question. So, as you all know from watching our previous videos, we inside our equity ETF portfolio and across all portfolios, we've actually increased cash, and that was a strategic trade that we made on August the 4th. So we increased cash positions. We're sitting there, we're looking at, do we need to increase cash now, wait till the next market rebound, which we may see a short-term rally. If we do, we'll probably increase cash again. And so we actually went and preemptively increased cash positions, which it really helped us out greatly. We made some strong trades in some areas that have done very well in the environment, which we've seen in a couple of different areas that are very inflation, that do well in an inflationary period of time. And so that's benefited portfolios. We made a shifting out of fixed income. And with fixed income, because when interest rates go up, the value of bonds and fixed income go down. And so we've gone to either a short-term rising interest rate, a short-term credit, which would be more of a rising interest rate investment. But then we also shift a lot of assets over to our buffers. And buffers, your rate of return is more of a pre-sold contract, if you kind of view it that way, where two parties have agreed to buy and sell on a certain day in the future at an agreed upon price, regardless of what happens in the market. So we have some built-in protection there if we hold to maturity, either a 5% down or else a 10% down protection. And so we've built that into portfolios, and so that's actually provided tremendously as far as with dividends. And so those are two things that we have done. We're also looking at increasing holdings in other appreciable assets, which would be land or real estate, with a strong dividend yield that's not tied to the stock market. And so those are things we're looking at bringing in. But then in addition, whenever we increase cash or we see money with our clients just sitting in the bank, and most banks, as you all know, as interest rates have increased, savings and money market rates have not really gone up accordingly. So we actually went out and negotiated pricing, and we're able to bring on a grouping of banks around the country, excuse me, in order to offer a higher fixed interest rate to our clients in a money market instrument with full liquidity, which starting on the 1st of October will end up becoming 2.15%. As far as with FDIC insured money market accounts. So there's things that we've already adjusted, which benefits greatly as far as with our clients so far. We're still some pain there, but we've actually limited that to the downside. And then in addition, we've also been able to work with a number of different fixed annuity companies, which, as we've always said, we look at tools within the season, and sometimes it makes sense, and other times we won't use those tools. So right now we can get a strong upfront 16% credit with certain products for certain clients as far as an interest credit, and then we can earn interest going forward with no as far as with downside risk down to zero as far as doing the stock market. So those are things. In addition, we have our continual relative strength, and so we're noticing some strong potential opportunities in local community banks. And so looking at potentially making a slight investment over there, which do much better in a rising interest rate environment. So all of that are things that we've seen that go along as far as with what we're doing, with what we have done and what we're currently doing.
Great. And so what we would tell you to do if you're watching this and John said something that perked up your ears, or you said, hey, I haven't talked with my advisor about that high yield savings account or about that fixed index annuity, what we would tell you to do is reply to this email, give the office a call, set up a 15-minute strategy call with your advisor so they can walk you through what we've talked about here from a background data standpoint and also from a solution standpoint, what you may need to do to stay on track no matter what's going on around us. And so, John, I think we've covered all the ground we wanted to today. What would just be one final thought from you?
I'll tell you what, it's all about create a plan and stick to the plan. There's confidence in the plan, and with the plan, we should be measured as far as for trough planning or worst case scenarios. The plans have worked out very well, very consistent. And so I'd say on everything, make sure we have a plan that aligns with your goals and with your risk tolerances, and then from there, that's how we move forward.
Awesome. Awesome. Hi, everyone. Thanks for the time, and we'll talk to you soon.